Well, there is a bit of a bounce in equity markets after Monday's carnage. The question is not just about what a trading mind should do, but even if you're an investor, how do you approach a situation which is as volatile and as uncertain as is right now, because there are 2 or 3 moving parts to this whole picture. Let's try and understand what a long-only fund manager is thinking about in a situation like this. Pankaj Tibrewal, founder and CIO of Ikigai Asset Managers, joins us right now on the show. Pankaj, great having you. Thanks for taking the time out, and an opportune day to have you really because of all that's happening around us.
Thank you, Neeraj. It's a pleasure to join the show.
Thank you so much.
I'm looking forward for the conversation.
Yeah. How do you think about what's currently happening, Pankaj? Because there is a fair degree of uncertainty with regards to the yen carry trade impact, with regards to what the Fed does or doesn't do and the resultant impact, and a renewed bout of geopolitics hovering above us.
So I think it was a combination of all three. And, Neeraj, in various shows of yours in the past few months, we have been pointing about the excesses on valuations which have been created. And reasons are known on the hindsight always. And the reasons came in the form of yen carry trade, geopolitics, slowing down of US economy. But I think the trigger was that asset bubbles were getting created across. Look at what happened in the 2-week period. The US volatility index, which was sub 10 just 2 weeks back, touched a high of 80 yesterday. And think about the algorithms, the entire machine trading, portfolio-based things, which created that. So I think one thing which we have learned over the last 2 decades is that it's futile to make a prediction about the future events. I think, at least for myself, I know I'm very realistic about my abilities in life, and it's very futile to make predictions of the future. What you have to focus on is portfolio construction to make sure that your portfolio survive across cycles. And I think this volatility is going to stay for some more time. And I think my sense is that there could be a shift in sectoral allocations after a sharp knee-jerk reaction which we saw globally over the last few days. And don't forget, in the last 3 trading days sessions in August, the entire gains in calendar year in Japan has been wiped off. Such are equity markets. So we believe that you should always weigh your risk reward. In today, many sectors which I see even in India, the risk reward is not in your favor. The valuations are excessive. There is narratives. There are thoughts, stories prevailing out there in the market, and one needs to be careful of what not to do. And I think this is a market of elimination rather than selection. I think you need to eliminate what you do not invest in, because many places I see there is a risk of permanent loss of capital because only narratives are floating around. There's very little delivery on cash flows and earnings.
I'm going to get back to these last 10 words that you used in just a bit, Pankaj, but I want to come to the major question first. Reasons come later, but reasons cause corrections. Is 4% a correction enough, or does it need to be more? Do you reckon it can be more?
It's a tough question, to be honest, Neeraj, but look at some of the data points. I think the market has been too charitable to all of us over the last 2 years. And most of the stocks have made you money across. When I look at the data points now, I believe that the market breadth has started to narrow down. Why do I say so? Last year, the earnings growth across on a headline basis was 30% for NSE 500 companies. And many companies delivered 50 or more than double their earnings also, because margin was an important lever for earnings growth. FY25, the first quarter had started on a very subdued note. 300 companies out of the 500 NSE 500 have reported till day before yesterday. And the headline number is just 3% earnings growth. And when I bifurcate this 300 into 2 parts, 71 companies are banking and financial services company. They have grown their profits at 21%. But the 229 companies are non-banking and financial services company. They have degrown their profits at 11%. So earnings is started to slow down in our view. This year would be a difficult year. Not every stock would participate. And our sense is that the market breadth will get narrow and markets are likely to consolidate at these levels. And it will be a stock pickers market as you move ahead in the next 12 to 18 months. So it's very important that you navigate the cycle quite carefully because in a sideways consolidating market, there is risk of making mistakes. So overpay, stick to your fundamentals, stick to good promoters, good management teams, and good balance sheet and cash flows.
Pankaj, just wondering if the lessons of the last 2 decades have to be rethought a little bit simply because of the difference this time around post-COVID of the very strong domestic flow, which is sticky. I mean, perennially for the last 2 decades, or rather for the last 2 decades, FI flows dominated, but they were also fickle in that they came and they went. We are seeing a very sticky nature of the domestic flows, right? 15, 20,000 or whatever the net number might be coming in every single month. Does that change the way you need to think about how stocks would behave? I mean, I remember the age-old thing was that when your panwala is telling you that ye stock le lo, that's the time to sell the market. The panwala has told me this for the last 2 years and the markets have still gone higher.
Absolutely, Neeraj. I think we all are, for the first time, seeing a tsunami of flows, and especially from the domestic investors. But don't forget that the basics of investors has been tested across last 100 years. And it's not today that these things are there. And over a period of time, my belief is that these fundamentals won't change. There will be asset bubbles which will be created. And one important saying which I always love it is that the asset bubbles, when it will end, nobody knows. But I only know how it will end. So you know that things when it becomes too much, finally at the end of the day, the asset bubbles try to, it's the unwinding is very painful. So I'm only suggesting that yes, flows are very strong. They will keep on supporting the markets. FIs to a certain extent have become irrelevant in the marketplace today. But don't deviate from your basic fundamentals. Flows will only be supporting your overall thesis. But when earnings growth starts to slow down, capital can evaporate from one sector to another very fast. And we're seeing in many of the names, just few thoughts, many names which were darlings of the market over the last 6 months, over the last 1 or 2 months are down by 30 to 50%. So be clear that you don't get carried and swayed away by narratives. Finally, there is delivery, and you are there with good management and promoters. If you dilute any of these basics at the end of the day, short term you may become a hero because of the flows and other things, but over a medium to long term, there's a big risk of permanent loss of capital. And I only fear that one should not take investing decisions where there is a risk of permanent loss of capital.
Got it. So Pankaj, what are those pockets? I'm now referring back to the first answer, and then I'll wrap up with the portfolio construct. Where is it that you find that the narratives are so strong that it will destroy investor wealth completely? I mean, what are those themes largely where there is narrative not backed by commensurate earnings growth?
So let's take example of few of the sectors where there's significant exuberance. I may not say that they may lead to permanent loss of capital, but there's significant exuberance. Let's look at the overall market cap of defense and railways today. The combined market cap is at 18 lakh crores. FY19, the combined market cap was 1.2 lakh crores. So 1.2 lakh crores moving to 18 lakh crores, which means a CAGR of 67% on market cap terms. Now look at the commensurate profit CAGR. Over the same 5-year periods, it's about 21%. So you had a 21% earnings CAGR, but a 67% market cap CAGR. The earnings multiples have expanded massively. many of the names on the EMS platform, where there is huge narrative about electronic story and other things, many companies don't make cash flow. So if you add over the last 5 years cash flow of these operating cash flow of these companies, you don't get a comfort. They are either flat or marginally negative. Their profits are growing, accounting profit is growing, but commensurate operating cash flow is not, which to me is always a recipe for disaster because top line is vanity, bottom line is sanity, but cash in bank is finally reality. So you did not, deviate from such basics because whenever market slows down, if you're not generating cash flow and only accounting profit, it will hurt you. And finally, you need to fund your growth either through debt or diluting equity. So in many cases, we are seeing some of these kinds of companies are tapping the market on a 6 to 12 months basis with equity.
Got it. Wow. Okay. So, well, viewers, do the research. I don't think Pankaj is saying that if you own a defense stock that is necessarily overvalued, it may not be. But do the research well on railways, on defense, on EMS, some of the sectors where the valuations seem very stretched. Pankaj, I would wrap up this conversation by asking you, where is it that you may be sitting on cash, which is fine, or you may not be, but what is your most overweight position currently, sectorally or thematically, and why so?
So, Neeraj, I believe that there are 3, 4 themes which we are liking. First, I think consumption, and especially mass consumption, has been under pain for the last few years. We see that changing. And sectorally, if you look at the allocation of investors, it's at a very lower number today. So I think incrementally, when you see the results also this quarter, FMCG and consumer discretionary have started to show incremental positive change. And I think consumption on discretionary staples, mass consumption could be one place over the next 12 to 18 months. The second is the entire auto ancillary space. I believe there's a significant change happening in that space where a lot of auto ancillaries are also pivoted themselves to industrial parts. And many of them will see very strong earnings momentum over the next few years, not only led by autos, but also by industrials. And they are also significant players now in defense, railways, and stuff like that. So that's something, and valuations are not, very exorbitant. The third is pharma, and we saw the results on pharmas also, both on domestic and US generic. There seems to be decent delivery by most pharma companies. Fourth is financials. On the private sector, I believe valuations for the franchise and the deposit franchise they own, I think was quite reasonable. And after 3 and 4 years of underperformance, I think private sector financials can make a comeback. So these are the few areas where we are positive. And the contra bet will be chemicals. Incrementally in this quarter, we have seen mixed response from few companies. Some companies have shown incremental positive change. Some are still reverting back to mean. I think this space, if it comes at a decent valuations, could be interesting space to look at. And last but not the least, I forgot, the entire power value chain. Valuations are challenging, but it's a mega trend in making, not only in India, but globally. I think transmission is one area where I think there will be significant investment globally being done because the kind of electricity requirement we are seeing in terms of growth is unprecedented. 20 years, US was having a flat growth. And now after 20 years, you are seeing 2 to 4% growth in electricity in US itself. And transmission grids are not equipped. So I think in US, globally, and in India, you will see huge capex on transmission. And hence the entire value chain starts to look very attractive. Valuations are only challenging right now. So in this correction, if we get some good names at a decent valuation, that's one area to look upon.
Pankaj, so good talking to you. Thanks for sparing the time today and talking to us. Really appreciate your time.
Thank you, Neeraj. Thank you.
And viewers, thanks for tuning in.